Hello and welcome to this valuation tutorial on SaaS metrics. I'm talking about software as a service, valuation metrics and multiples. In this tutorial, I'm going to take you through two examples. One is my own business and the second one is a company called Afterpay, an Australian technology company that is taking the world by storm. We'll use these two examples to explain things like churn and retention, gross margins, customer lifetime, average revenue per user, and total value of all customers. This is a really good tutorial if you're getting started valuing these businesses and you want to know the nuts and bolts, where to find the information and what to do with it. I'll go through each of those different tools that you can use in great detail. You'll even have access to the spreadsheet on our website. Speaking of our website, this valuation tutorial forms part of our Value Investor program where we take you through all of the different types of valuation tools and strategies you can use to value pretty much any business. If you want to learn more about our Value Investor program, you can head to our website. Thanks for tuning in. Let's get stuck in.
So here we're looking at SaaS metrics, or software as a service. And these types of metrics get thrown around a lot when you're talking about technology companies, and particularly companies that are software companies and build their products in the cloud, so online on server farms well away, chances are, from where you are. They're building programs or products that you can pay for on a monthly or yearly subscription. And that's why it's called software as a service, because it's a service that you can take up in the cloud anywhere, anytime. This is a primer video on SaaS metrics, how you can calculate them, how to understand them, where you get the information, and I guess the power of different types of loyalty, different types of margins, and I guess just the way that those interact to create a brand or product and company that is incredibly more valuable than another company which maybe doesn't have high amounts of retention, doesn't have wide gross margins and operating leverage, etc. I'm using Afterpay as an example, but you can find similar type metrics for our case study in PushPay or pretty much any technology companies. And how you go about finding these things is actually it actually puts a bit back on you as the analyst to be creative. So, for example, here we've got users added. You could get users and total users from the company's financial statements. So typically they'll be in investor presentations or analyst packs or those types of things which are readily available in your brokerage account. Another way you might even get a little bit creative with this and kind of forecast into the future is you might have some resource, so some data feed that you have that maybe few other investors have. So one of those things would be, for example, you might estimate, for example, the number of downloads of a particular app in the App Store, or you might gauge the significance or the growth in a brand or product by the number of people that use a particular forum or support forum for that company. You might be able to register and find out more about them. You might even, and I'm just going to go to a new website here, we're going to go to trends.google.com. So I'll bring this down for you. So this is Google Trends, trends.google.com. And here we might say search for something like Afterpay. So we'll just go Afterpay, not the actual company, but the product Afterpay. And we might research Klarna, which is the, rival in many different areas. So this is in the United States. If we go to the United Kingdom, which is where Klarna is from, and Afterpay has tried to grow recently, you can see that Klarna is far more popular. If we come into Australia, yes, that's what I want. Thank you, predictive text. Over the past 12 months, we can maybe go back a little bit further, 5 years, and we might say, compare it to, what's another one? ZipPay. Let's have a look at the difference here. So you can see that according to Google search trends, Afterpay is far more sought after than ZipPay. You might use something like this, not for its absolute number, but just to gauge the expected growth. Obviously, people are searching for it, they're looking for it, and if they're looking for it, it means they're likely to use it. So you might use that as a basis for forecasting growth rates for users. Another way is obviously the company disclosing them, those numbers to you. You might read other analyst reports and see where they get their information, etc., etc., etc. Moving further down, the margins, you can see here that anything in blue is historical, anything into the future is an assumption or a forecast, and we've just made some very loose, very basic assumptions here. This is not a prediction, these are just to make the tutorial relevant and easy for you to understand. You can go in and tinker with these as much as you like. So we will step through these in just a moment, but I want to back out something and something that's really important, and I guess this is the theoretical underpinning, because it fills in a lot of the blanks of how you go about finding these metrics, what they mean, and I guess the limitations that they have. So I'm going to give you an example of the company that I run, and hopefully you can relate to it. So let's say that you come onto one of our websites. This is our news website, Rask Media, and you come on and you read an article. This one was published by me not too long ago. You can see that I've written an article. People read this, blah, 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 blah. They click on it. They love it. Oh, great photo. Not. But they come through, they read it, they like it, and they get to the bottom. There's a lot of ads, excuse me, and they see something like this. And in marketing, this is what we call a pitch. But basically, they've read this article. They come here and we've said, hey, why don't you take our free valuation course? Or hey, why don't you get a free report from us? In doing so, you will be added to our mailing list, our newsletter, in other words, and you get some value. We get your email address to market to you. And then hopefully from that point on, we can upsell you. And so then we might say, okay, user, you've been added to our mailing list. I'll start marketing to you our paid product, which is say $500. So I've just used this. I've actually just created this web page as an example, but let's say it's $500 per year, and you can get all of my stock research, and you can get my, I guess, share tips and recommendations and anything that you want from me, because you think, hey, Owen, you seem really good at this value investing stuff. Maybe I could just pay you to do it. And then you can pay me $500 a year. This is obviously just an example. We used to have a service like this, and we might have one in the future again, but this is just an example. So it's $500 per year. First of all, you had to get to this article. So that cost money for me to get it here, either time or money. I wrote this one, but if you went on and you searched for other articles on our website, you would see that I'm not the only one that writes these. So I have to pay for someone to write this article. Then you have to join our mailing list. And then, so there's 3 steps, you have to pay me for a service or access to something. So let me put that down in a piece of paper, in a sheet, sorry. Let's say there's an article cost. So the cost for me to get someone to write an article like this, run right here, might be $50. Let's just use round figures, $50. And let's say for every for every article that we publish, we get 20 newsletter readers. So $50 is what it costs to produce this, and we get 50 people follow right down the bottom here, click on this link, and they either take a course or they get a free report and they join our newsletter. So we get 20 people from that. I'm going to show you why this is important in just a minute. But before I do that, I want to introduce you to some of the metrics that we talk about when we talk about SaaS businesses, marketing, just business in general. So one of the things that we talk about is something called the churn rate. And the churn rate is a really important measure for pretty much any software business, because remember, if you go back to our other tutorials, we've talked about how, and these are other tutorials in the Value Investor program, by the way, we've talked about how having a moat or a competitive advantage leads to customers hanging around for a long time. So, a bad example of this would be like a supermarket. Typically, you don't really care where you shop for your baked beans. You would go to XYZ supermarket, or you'd go to ABC. So there would be a lot of churn. You would just go from one to the other, blah, 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 blah. Who knows? You might be more, I guess, religious in where you shop. Maybe Aldi over Coles, or Coles over Woolworths, or Woolworths over IGA, or whatever it might be. But typically, when you look at financial statements, you'll see something like, it'll say the churn rate is 5%, or the churn rate is 10%, or the churn rate is 20%, or our churn rate is 50%. And what they're saying here is we lose 5% of our customers, we lose 10% of our customers, we lose 20% of our customers, and we lose 50% of our customers in 1 year. So this is typically, expressed yearly. It might be expressed, and this is where it can get a little bit confusing, is they might say we measure it as a percentage of revenue. So I'll get to what that means in a minute. But let's just say in fractions, so let's go back to high school maths, let's ask ourselves, what are these numbers in fractions? So 5% is 1 divided by 20. I'll do it here. 1 divided by 20, just so you believe me, that's 0.05, or if I put it in percentage, 5%. So you know I'm telling the truth, math works, blah, 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 blah. Okay, so 1 divided by 20, what would 10% be? 1 divided by 10. And 20%, 1 divided by 5. And you can go through and check on my math if you really want to. 1 divided by 2 for 50%. So we can see some numbers here. Okay, so these two numbers are exactly the same thing. They're both exactly the same thing, just expressed differently. So what we get here is a measure of the number of customers that are leaving us every year, the number of customers that are leaving us every year. But what we can do from here is we can say, okay, if that's our churn rate, we know how many people are leaving us. Let's talk about how many people are staying with us. And I'm just going to make this a little bit bigger for us. We know that 5% of people, which is this here, leave us every year. But another way we could put that is, on average, once in every 20 years, which is still 5%, because 5% of 1 in every 20 years is still 5%. Once in every 20 years, an average customer leaves us. So what I mean by that is, if you have customers that stay around on average 20 years, it means that, 5%, there's a 5% likelihood you'll lose that customer every year, because that's what it works out to be. We know from the math here that 5% is 1 on 20. That's like saying 1 in every 20 years, we lose them. And we could say the same thing here. 10% is on average 1 in every 10 years. 20% is on average 1 in every 5 years we lose that customer. Same for this 50%. So we get some numbers here, right? And you're beginning to see how powerful churn rates can be. In other words, how powerful retention can be when you have a very sticky product. Because if only 5% of customers are leaving this year, that's a heck of a lot better than if 50% of customers leave this year. Because it means you don't have to acquire another 50% of customers just to get back to where you are. This would be like, you've seen the videos, the cute videos online where there's a duck and it's swimming in the water. You see the duck kind of just moving slowly across the water. Maybe it's like a pond or a lake or something, but its feet underneath the surface are scrambling really quickly. In this example, if you are a company and you're trying to grow year on year, you have to get back the 50% that you're expected to lose, but also whatever growth you want for the next year. So you have two major focuses: retaining customers and growing them. And growing new customers or winning new customers. In this case, if you have a super sticky product and you're only losing 5% a year, you might even be able to increase prices, and then you have only lost 5% of customers, so you have a great product. Let's say, for example, that you raise prices by 10% for everyone every year, and you only lose 5% of customers. Well, you'd be crazy not to just keep doing the same thing, because you're only losing 5%, but you're getting 10% from every price increase, because people can't give up your product. Maybe it's a super sticky software product. Maybe it does the software that goes in the signs on public buses. There's an actual company that does that. It does the software that displays what stop it is, when to get off, what bus route it is, and obviously, the bus companies don't want to rip out that software and put new software in because it uses GPS and blah, 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 blah. It's really sticky. So there are actual companies that achieve even better than 5% churn rate. In other words, have a customer retention more than 20 years in the future. A German company by the name of SAP, which is arguably the biggest enterprise software company in the world, installs its software in big corporates, and those corporates become so dependent on the software that they're unlikely to give it up for, let's say, 40 plus years. So, in other words, their churn rate is even lower than this, so their retention is even higher. For example, if you have a 2% churn rate, the other way of expressing that is, not 1 in 2020, it's like saying 1 in every 50 years a customer leaves you. In other words, a 50-year retention rate. So if you have a business like that, you don't have to be that duck that's swimming across the pond. You can just keep growing, and pretty much every customer you add is super sticky, super valuable. But here's the important point for moats. The key measure of the power of a moat is not necessarily how many customers you keep, but how many customers you keep and how high you can raise prices or cross-sell to those same customers and keep them. So if you have a 5% churn rate, but you have a free product, it's not really valuable to you. But let's say you have a 5% churn rate and you're increasing prices 10%, like I said before, then you have a very valuable product because you know people can't give it up and you can charge more for it because you know it's valuable to them and they know it's valuable, so they're not going to give it up. Anyway, I wanted to introduce this idea of churn rate and how powerful retention can be. Sometimes retention isn't always spelt out in years. Sometimes it's spelt out in revenue, so revenue retention. And this is there's an important distinction here. Revenue retention, and I'll just write it down. If I can type. Revenue retention is a percentage of how much of last year's revenue is spent in the year ahead. So, for example, they might say 110% revenue retention. What that means is customers who spent 100% last year, because that's everything they spent, so it's 100%, they might be spending 10% more this year. So a positive number tells you that the company is able to extract more revenue from the same customers over time. But the distinction here between this retention figure and this retention figure is this one tells you about individual customers on average. This one just tells you about the revenue. So they might actually be losing customers, but they're saying of those that we keep, we're earning more from them. So it's kind of two different things, but it's still a pretty commonly accepted way to, estimate these numbers. Okay, let's go back. Let's take a breath. Let's go back to my example. So here, where we have Rask Media, the good old Rask Media, people read our articles, they click on this link, they join our emails, I bombard them with marketing, just kidding, but I do send them some marketing and I say, hey, join this and you'll get amazing stuff for $500. And they do. So we estimated that it cost me $50 per article written. So I have to pay someone to do that. And from that, I get 20 email addresses. So people joining my newsletter. Okay. But let's say, I'm going to beef out the numbers, let's say we write 5 articles. So we write 5 articles. How much would that cost us? Well, if we know the price per article, we can estimate how much it's going to cost us for 5. So this would just be that times 5. $250 for 5 articles. And why am I going for 5? Because let's just say newsletter readers from 5 articles. Why am I doing this? Because it keeps the math simple. 20 times 5 is 100 newsletter readers from 5 articles. This is equivalent to this. It's just that this stuff is multiplied by 5. So you keep up where I'm going with this. You can see this is just that multiplied by 5 and blah, 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 blah. And obviously 100 sounds like a pretty groovy number, so we'll go with that. Okay, now, here's another step they need to take. We know that they need to get to this article in the first place, so I have to pay someone to do that. But then they join my mailing list. So then they click on this link down the bottom here. They click on this link and they join my mailing list. They might get a report or whatever. So how many people that join my mailing list actually go on and subscribe to the paid version? So there's article, newsletter, let's just call it where I do some marketing, and then there's paid product, right? And at each of these steps, we'll call this person a reader, newsletter reader, and you can call this one customer or user, right? So that's the basic flow. That's the flow of customers / marketing funnel. All right, so you're keeping up with me. You know where we're going with this. This is how the business works. This is how any business works. You could own a bakery and you should still know how much it costs you to get a customer to walk in the door through advertising or marketing. You know, you get foot traffic, that's obviously reflected in the price of your building. Anyway, that's a digression. So how many people go from being conversion rate? How many people go from being a newsletter reader to being a member or being a user or being a customer? This is what we call a conversion rate in marketing. So I'm going to estimate 1% of the people, 1% of this 100 people then go on to buy one of our newsletters or one of our courses or whatever. I mean, you're doing this course, you got here some way. Chances are it was some other weird way, but if I could estimate it, this is how I'd estimate it. I'd say 1, maybe 2% of people that come through then go on and pay us some money. Yes, we give a lot away for free. So what's the price of our product? Price of a product. So for me, we know that in this example, it's $500, right? So let's say 500 big ones, 500 clams. That's that one there. So we have a conversion rate, 1%. We have the price of our product, which is $500. Okay, we're getting there. Now, what is the revenue that we would get per 100 readers, aka customer, per customer? Let's go, aka per customer, or per user. We'll keep the language simple. So what is the revenue that I would get from 100 readers, aka per user? Well, that's simple. We know that 100 are coming through, but only 1% of them are converting. So what we can do is we can go like this, multiplied like this, multiplied like this. So what we're saying is, and we know that this is this figure, only 1% of people out of 100 is very simple. Only 1% of people take on our product. But let's say our conversion rate was 2%. You'd see the revenue would go up. You know, this would be revenue per 100 readers. It wouldn't be users anymore, but it would be revenue per 100 readers. So I'm going to keep it simple and keep it at 1%. Now let's say, what's the cost for 100 readers? What's the cost for 100 readers? Well, the cost, we know, was 5 articles. That's all it cost us. That's all we're taking into account here. $250 to get 100 readers, right? You're following along here. So 250 clams. Now, we can say that the cost is per user would be $250 per user because we know it's only 1%. But if we got 2% and the revenue for that 100 was $1,000, because the cost doesn't change, we're actually getting more margin here. But I'm just going to keep this simple at 1%. Now, what's the next step for us? Okay, what's our gross margin? How much do we make in dollars from each 100 people, from every 100 people that come? That's really bad English. Let's estimate how much we get from all 100 readers that come through. So we have revenue or sales minus costs, right? We just have $500 minus 250. So this is for every 100 people that come through. But because we know there's a 1% conversion rate, this is really this is the cost per user, the cost per customer, because we know only 1 out of 100 come through. I'm just using 100 here so it keeps the numbers familiar. But we can say the gross margin per user is $250. That's $500 minus 250 equals this. Okay, we're getting there. But what is a gross margin in percentage? If you're like me, you always get confused when people are like, yeah, the gross margin is 250. What are you talking about? Percentage, or are you talking about dollars? So I always get a bit confused. So let's just say it's 50% because we know, and I'll actually do the formula, 250 divided by a top line is 50%. That's how you get to a gross margin. You'll see why in just a moment. This is so important. I'm going to even just go like this. I'm just going to say gross margin bold. That's how serious I am. Okay, so next thing that we've got to do is what's the average revenue per user? So ARPU, average revenue per user. Now, we know this is very simple, right? We know that it's $500 because I said to you before, we know it's $500 because there's only 1% of people coming through. 1% of people out of 100 gets us to $500 revenue. So we know that. So we know that the average revenue per user is $500. So let's just say it's $500. So average revenue per 100 readers, which also happens to be average revenue per individual user. So now let's move down. Let's go to the churn rate. We know that I produce this, website. I have a newsletter which then gets some money from people if they choose to join. So how many people would we expect to leave this every year? I mean, it's not like I'm zero and I'm creating software for businesses that they need every day, or push pay and I'm creating software for churches, and churches have big budgets and the software adds a lot of value and it's hard to replace and all that sort of stuff. Let's just go with something simple. Let's say 50% churn rate. That means I think 50% of our customers will leave this year and probably never come back. Let's just say that, all right? Because they want the research, then they get lost. That's a really unendearing way to say that, but that's just the truth. So in fractions, we know, because we've done our lesson on fractions, hey, just up the top here, 1 in every 2 years, all right? So retention is 2 years, right? So fraction, I should just do it, keep it simple, Owen. 1 in every 2 years. That's our fraction. So we set up here that it's retention in years, right? Like this equals this in years. This equals this in years. But another way that we can talk about this is something called customer lifetime. So the life or the time that this customer is going to spend with us, the part of their life that they spend with us. So it would be 2 years. So this is in years, right? We know that this customer on average, or the average customer spends 2 years with us because of these churn statistics. We know it's 2 years, and you can go back and review this up here. So customer lifetime is really an important metric because it kind of signals how long do you keep someone. Yes, we calculate that based on churn, but it's really, we'll go 1 divided by this. But we know it's really a function of the stickiness of a product and the ability to increase prices. These are the two things that will determine the fate of many companies in this space. So bear with me, we're almost there. So if we know the gross margin, we know the average revenue per user, and I should bold this too, how do we calculate what each individual customer is worth to us over their lifetime? Well, we do something, and this is very common, lifetime value. And this is often called LTV. And I'm just going to do the formula here. So LTV is calculated, it's the average revenue per user multiplied by the gross margin in percentage, multiplied by the customer lifetime. And this effectively tells us how much revenue do we get from them, okay, and what's our profit margin on that revenue, and how long do they stay with us? Because if we've got a 50% margin up here, what a churn rate or 50% retention, what we're effectively saying is the person gives us revenue today, then 50% next year, then 50% of that figure the year after, then 50% of that figure the year after that, and so on and so forth. And we can estimate that with this simple formula. So we know that for us, the LTV for Rask, so Rask's LTV is ARPU multiplied by gross margin, and then multiplied by the lifetime value, so $500. Every customer or every user that comes through us, we estimate is worth $500 to us, right? So $500 is what I estimate people that read our article, then pay, then stay with us. We estimate that the most that they'll pay us from this model is $500. Okay, but let's say, just for the sake of it, let's say we have 100 or 250 users. Sounds pretty good. So we have 250 users, and that would give us a total LTV of all users. I'll make that simple here, of all users, of just obviously the value per user multiplied by the number of users we have, $125,000. So that's what we expect to extract from these customers for the life of the customers. So 2 years from all 250. Now, what's something else that we can do with this? Can we toy with these figures to see how we can improve our business? Let's use some of the figures from up here and let's start to tinker and figure out how we can make money, how I can make more money. Wouldn't that be lovely? Let's start to throw some numbers around. Okay, let's say that our margin for Rask stays at 50% into the future. So we got 50% into the future. Let's just say that I don't make any changes and the gross margin, I can't bring down the cost and I can't influence how many readers come through. Let's just say that, and I can't influence my conversion rate. Let's just say that the gross margin stays at 50%. Okay, normally you'd be able to change things like lower the cost or increase the revenue or the prices per product or blah, 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 blah. But for this, we're keeping it very simple. Let's say the average revenue per user that comes through actually increases. I'm just going to hard code this in. Bear with me for a second. 100, let's say the average revenue per user goes up to $1,000. And then let's say in another alternate reality, we can make $1,500. So let's say instead of me charging $500 for a service, I charge $1,000 up here, and I charge $1,500 up here. Apologies for the formatting. And I haven't even tinkered with the conversion rate. I'm just saying I'm charging more up here, which then leads to more revenue. Costs stay the same. The gross margin obviously would increase, in dollar values would increase, and so would the margin here. But let's just say the average revenue per user goes up. We've invested the same amount of money. So in this case, it would be 500. In this case, it would be 750. So let's say that we've invested more. We're getting more revenue per user for whatever reason, right? So here we've got some churn statistics. Let's plug in some different churn numbers. Let's say that instead of losing 50%, we are going to lose 20% this year and then 10% that year. So these are, I shouldn't say year, but these are really just strategy 2, strategy 3, right? So different strategies, if you like, different ways to influence the customer, or different businesses, if you like, altogether. Maybe someone else is doing it better than I am. In fractions, we know that this is that, this is that, this is just up here. You can pull these from. So customer lifetime is 5 years, customer lifetime is 10 years. We know the formula stays the same. So what we can effectively do is just drag it across. We can now say that Rask's lifetime value per user has gone up dramatically. So from $500 to $2,500 to $7,500. Why? Because the customers are staying with us for a lot longer, and each year they're paying us more. It's as simple as that, right? Now, what we do is we take our user numbers and we hold them constant. Let's say we've still got 250. We can't really influence that. But because we're earning more from them and they're staying longer, here's what happens to our total lifetime value of all users. So we've still got the same number of users. We've only increased the lifetime, value, or lowered the churn rate, if you like. And we've kept the same margins. We've just earned more. So we've just charged more, but we've scaled really well because we didn't have to spend more money to acquire more customers. We just spent effectively the same amount, but we've charged more for the product. So what we have here is a dramatic increase in lifetime value. So we might even be able to plot this. If I just go like this, let's say we have a chart. Did it do anything? Let's go one of these. So you can see here that the different strategies, although they're very similar, we've made some assumptions, and the value of the business, of my business, of our business, has gone up dramatically. Yes, it takes longer for us to realize that money, that, for them to actually pay us, but the stickiness has meant that they stay with us longer and they're more likely to pay us. So the value of this franchise goes up dramatically. Now, this all sounds like a bit of confusing nonsense. I hope you've stayed with me. If you need to review it, please go back and listen to it. But what now I'm going to do is I'm going to put this into practice, and you can see how it works with a real life company, and you can see why my business sucks compared to other businesses. Now, I'm not saying it sucks, but you can get the idea. So up here, we have Afterpay statistics, and these are just pulled from their reporting suites. We've got, as I said, you can estimate total users, or you can get it straight from the analyst pack. We've got margin statistics. I'll go through all these in just a moment. We've got the marketing and communications expense. So this is what I'm using, and this is from the notes in the financial report. So the notes in the financial report, the marketing and communication expense is pulled from the notes. I'm using this as a proxy for how much it costs to get a user. So if they spent $31 million on marketing, that's the marketing cost to get a user to download the app and start using it, right? That's you can get that in the most companies' annual reports under the expenses line items. Okay, so let's just go through it. Let's use 2019. So we've got users added. That's just the difference between how many they reported they had this year and the year before. We've got the gross merchandise value. So this is confusing. What it actually means is just the retailers that use Afterpay, either online or in store, how much is going through the Afterpay app to those retailers. So this is not what Afterpay makes. Afterpay makes a revenue margin or a margin on that. And then so you get down to the reported revenue here. This is what goes to Afterpay. Okay? And then you can look in the financial statements and you can find the cost of sales, which is this. So this would be like the different costs associated with running the business, and we have gross profit. They make 77% margins. That's pretty bloody impressive, right? I didn't even include any of the other costs when I did my little example, but they've done it here. That's pretty impressive. Those are wide margins. They're better than the 50% that I estimated, but again, different type of business. So we have EBITDA down here, just again pulled from the numbers. The estimated churn that we have here is what we've estimated just over time. We're seeing more customers added. We haven't seen that many leave. So we're just kind of making an estimation on the churn statistics. And going forward, we've used a very, very, very simple thing here. You can see Afterpay reports on its customer retention rate, but you can see that we've made, these are quite, and this is where you could change your perspective of whether, or opinion of whether Afterpay is a buy or a hold or a sell. But this is probably one of the most crucial inputs, as we know from the work we did down here. This is a very important input because it directly affects this number here, the number of years that a customer stays with Afterpay and uses the product. But anyway, this is just an assumption, and it's a very simple one of that. So we've got the marketing and communications expense as the cost to acquire each new customer, and we get that from the notes in the financial statements. As a percentage of revenue, you can see that we don't estimate they're going to be paying a lot of money going forward. So to get to this figure, we've just, what have we done? I-18 multiplied by 5%. So 18 is further up here, right here. So we've multiplied that by 5% to get to the communications expense going forward, a very simple model. So we have our estimated customer acquisition cost. And so what is that? The estimated customer acquisition cost is very simple. It's the users added divided by how much they spent on marketing that year. So they spent, say, $44 million on marketing and communication, and they added 1.3 million users. Obviously, when a product goes viral, that's free marketing for the company. Another touch of genius for Afterpay is that they get retailers to advertise for them by saying, we accept Afterpay, come in store and use it today. And then people are like, oh, that's fantastic, I'll shop there. So the retailer seems to win, the customer seems to win, and Afterpay definitely wins because they get free marketing. All they have to do is send them off a sticker to put on their window. Okay, so we can estimate the average revenue per user by just getting revenue and dividing it by the total number of users. So just up here, it's pretty simple, right? Like you have this number of users, we earn this much in revenue, therefore one divided by the other gives you the revenue per user. Now we have the lifetime value, which we know comes from the formula that we have here. Average revenue per user multiplied by the gross margin in percentage terms multiplied by the customer lifetime. Simple, right? And then if we go down further, we know that we have this number of users. So if we multiply the lifetime value of an average user by the number of users, we get the total value of all the users that we have forecast into the future. So at this point in time, it had nearly 6 million users. We're saying it will have nearly 6 million users, we've estimated. That means that the total value of all of the users inside the business are $6.6 billion. Now, we've also taken the market cap, the market capitalization or the value of the shares, all shares in the company at each point in time. So you can see, for example, here that in 2016, the total values of all users in Afterpay, according to these formulas, was $3.2 million, and the value of the company and the equity in the company or the shares in the company was 264 million. Jump forward, it's got 126 million users. It made a merger and did some other things, and it's grown quickly. But now the value of the company's gone up. The value of the users have gone up the year again after that, but the company's value has gone up again. So basically, there's a recurring theme here. It looks like you can't just price it off the value of the customers and then think that that's the fair value to pay, because it looks like the market value of the company is growing quicker than the value of the users. But that's just a little thing. So you can see here, right, that the value of the business is expected to explode between 2019 and 2024. You can see it's like a more than a 5-fold increase, more than a 6-fold increase, probably a 6-fold increase between here and here. And the reason for that is we expect it to add a significant number of users. Like even in 2024, we're expecting it to add 4 million users in 1 year. But if you consider that would only take it to 17 million total users, and the market for Afterpay in the United States could be in the tens of millions of dollars in that market alone, then here in Australia, it's already got a few million, right? So you can kind of rationalize this and you can think, well, that's actually probably reasonable that it would get to that. But then we have the margins that Afterpay charges the retailer. That was another assumption that we made. And it's a very crucial one. We've said Afterpay will earn 5% for every transaction that a retailer makes through Afterpay. But what happens when there's competition? What happens when Klarna or ZipPay or any one of these other competing services start to eat into Afterpay's business model? They approach the same retailers and they say, hey, Afterpay is charging you 5%. Maybe the impact of having Afterpay is worn down. We've got 5 million users that use ZipPay. We'll do it for 2%. So then you can have, margin compression in time, and you might find that the business actually starts to struggle. So you might put in something like this, and although this model is not created correctly, it doesn't update automatically, you might make that assumption, right? And then further down, we can say here, maybe the gross margin doesn't stay at 75%, maybe it drops to 50% throughout all time. And you can see the value drop from 24 million or thereabouts, 25, right down to 16 or 17 billion dollars in the future. So the assumptions that we make here are so important. But the biggest thing that we can do for any of these businesses is estimate the churn rate. So, you could see in the past that 35% of customers were estimated to leave, but we're only forecasting 5% in the future. Let's say it actually gets to a point, 5%, but then people start to leave. Just like most big apps, after a time, the fast movers leave, or they go to a new product and something more shiny comes along. So let's say that it actually starts to lose more customers than it makes. And you can see, or that it adds. So you can see that the value actually flops. So if we assume that the estimated churn drops from 5% to 25%, in our brains, we don't think that's a big deal, right? Like 5%, 25%, 10%, tomato, who really cares? But actually, investors care, because the value embedded in those users drops significantly. It drops from 25 million to 5 million. That's a huge difference. I don't even know what the number is. 20%? That's what you end up with, 20% of the 100% that you thought you might have. And so all of these figures play a crucial role in our modeling, right? And you're beginning to see now that, hey, Owen's pointing out some serious flaws in SaaS metrics. I want to be clear. SaaS metrics can work, and they are wonderful to get, an understanding of a business, particularly when it's not profitable. So I would use SaaS metrics for pretty much any software as a service business that maybe isn't profitable, but even one that's not, that might be modestly profitable, doesn't truly reflect the value of the business. But there are a few things. We know that it requires us to make some assumptions about things that may not always be clear. For example, is marketing communication expense the best way to measure how much it costs to get a user? What happens when Afterpay's product is no longer viral? What happens when the addressable market matures and they can't add this many users? What happens when retailers fight back? What happens when consumer confidence takes a big hit and people just aren't buying any product, not even through Afterpay, but through anything? And here's one specific to Afterpay. What happens when customers start to default on their credit? Afterpay lends customers some money, and then it expects it back into 4 equal installments. For example, I go and buy a pair of jeans, and then for $100, and I pay that back in $25 increments. Afterpay takes the risk that the customers won't pay back. What happens if we enter a recession? Does Afterpay just explode? Does it not? What controls does it have in place? How does that impact the business? All of this stuff that we've covered here is the shiny stuff. It doesn't say anything about risk. Unless we specifically model for bad outcomes, it doesn't actually say how much cash flow is going through the company. It doesn't estimate what's the tax impact of that. We've got to gross profit, but we haven't got down to net profit. It doesn't say, do you have big depreciation expense? Do you have a lot of debt that you need to pay interest on? What's your operating cash flow? What's your free cash flow? Do you have free cash flow? And so the big thing here for me is we've got these really impressive numbers to say, look how quickly you can grow based on the value of users. But then how do you answer the question, what is free cash flow? how do you model the cash flow of this business? Because that's ultimately what will determine the value of it. Not these shiny, impressive marketing documents that tell you, ooh, SaaS metrics. But then we come back to the big one. Churn or customer lifetime. As I said at the top of this video, the single most important things, or two most important things that you can focus on are how many customers leave and how much can you increase prices before they get paid off and they leave even more. So if you can retain 95% or you lose only 5%, Afterpay it looks like it's going to be a great business, provided they all pay on time. The customers don't default on their loans and the retailers don't give a crap that they're getting charged this amount of money, blah, 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 blah. Right? You can have a great business if your churn rate is low and your retention rate is extremely high. They're one on the hand, one on the other. The other thing, if you can increase prices, you are going to make a lot more money. So up here, you're going to make a lot more money. So then we have to get to customers that can charge more, so they can cross-sell or upsell, and they don't lose customers. And this, ladies and gentlemen, at the end of this video, is why we look for companies with extremely high switching costs, wide moats, and scale. They can add more customers and make more from those existing customers and keep them, and they don't have to increase their costs. This is the primer on SaaS metrics. I hope you enjoyed it. There was a lot of waffling. You probably put it on 2 times speed to get through it. But if you have any questions, you can reach out. This is the model. I'll make it available for you. I'll probably delete this, but you can go back and make it yourself if you want. Take a screenshot and then add it in. But basically, we've gone through, for our business, how the 3 different ways, I guess, we could try and grow the business and make it much more valuable. Then we looked at Afterpay. We also looked at the churn rates for generic businesses. We went through all of the common metrics, the customer acquisition costs, went through the lifetime values, the average revenue per users, churn rates, blah, 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 blah. We made some assumptions of this company, and you saw how if we change those assumptions, maybe it's not as rosy as we think. Okay, don't forget, if you're using SaaS metrics, to look at the risks as well as the impressive shiny marketing documents. Thanks for tuning in. I'll see you in the next video.
Thanks again for tuning into this SaaS valuation tutorial. My name is Owen Rask. You can find more of our free videos and tutorials on our YouTube channel, or you can subscribe and be the first to receive our next valuation tool that comes out and is free to use. Don't forget to subscribe. I'll see you next time.